How were you deciding which startup deserves to get the money and how much money?
I think there it's just important. The dynamic of the relationship is not, dear investor, please give me money, and you say how much you want to give me. It's the startup that has a trajectory that they're on, and they need to understand how much money do they need to get to that next point in their journey. What you talk about is value inflection point. It's a partnership, because essentially you're invested in the company and you want to see them succeed.
So what exactly happens when a startup fails for you on the venture side? Like, you invested in them money and then they say, hey, didn't work.
So one thing is, like, you consciously make a decision, we're going to try again to really get back on that growth path. Hi, Alex, so my company does this and I'd really like, because are you interested in giving me money? It's like, you're like, well, no, exactly. But if I'm like, because I also don't want to say, because maybe the people that I talk to will be listening to this and be like, really, you think I'm ridiculous?
Noroc, prieteni, bine v-am regăsit la podcastul Rethink IT. Eu sunt Alex Gurdila, suntem în studioul Moldova Innovation Technology Park și suntem la ultimul episod din acest sezon. Sperăm să ne vedem și la anul. Astăzi avem o discuție foarte interesantă în limba engleză cu un om care a fost special adus aici din Elveția ca să ajute startup-urile din Moldova să acceseze fondurile de venture capital. Ce este venture capital? Cum asta lucrează? Cum să ajungi acolo? Cum să colaborezi cu ei și de cealaltă parte, cum funcționează ei, o să ne povestească în limba engleză David Sidler, care este astăzi aici. David, hi, switching to English now. Welcome to the podcast.
Thank you so much for having me.
We were having a very, very interesting conversation that we almost forgot to start recording, but I'll do like a brief introduction about you and then we'll take. So just from your LinkedIn, you joined Verve Ventures when it was 4 people investing under 1 million Swiss francs a year. And then 11 years later, it had grown into one of Europe's most active deep tech VCs. In the meantime, you left and you're still focusing on VC and you're still helping startups grow and become the next Airbnb and Uber. So right now you're in Moldova, not just for the podcast, obviously. You came here to help some startups here reach people like you and access funding that they so desperately need. What did you see here, and at what, honestly, at what stage are we with startups in Moldova?
Yeah. So I was here to host two workshops where it was about, helping startups understand how do investors think, how to approach them, and then one, how do you negotiate an actual financing round with a company, get them on board. And then I had the chance to also have one-on-one sessions with the startups that participated. And so my impression of the companies I met is that people are very driven. There's a real hunger. People work hard. And again, also, I'd say the startup ecosystem in terms of mentality and grit is quite good. I'd say the limiting factor is, of course, that in terms of funding opportunities, it's still quite a young ecosystem. So there's very little capital here at startups' disposal to actually
in Moldova,
grow
in general, investment is just starting to walk, not even run.
So I'd say, and that's obviously when you're trying to build a scalable company that grows fast, if you don't have the fuel to sort of, let's say, drive that growth, you have some limitations. So I saw very ambitious people that are working hard, but obviously the focus is on regional markets, on local markets, and less so on expanding globally. I'd say that for a lot of companies, that's maybe something that can happen in a few years, but it's not something that's imminently available, I think, to startups now.
And we were talking about it earlier. Startups don't necessarily have to be the next thing that changes the world, right? A lot of people that fund startups want to have just a profitable business for themselves, because in our mind, sometimes when someone says, I have a startup, you immediately go, oh, this guy wants to be the next Uber. So not everybody needs to be or wants to be the next Uber, correct?
It depends from which perspective you're looking at it. If you're looking at it from the perspective of the person who's starting the company, if you if you're running a company, building a company, I think there is a good case to be made in a lot of cases. Hey, just build something that's sustainable for you, that grows at a good pace. But if you want external funding, if you want to get money from investors, you need to aim to be huge.
Okay.
Because if you're investing in a young business, in an early stage business, the risk is always very high. If they're trying to get to 2x, 5x, 10x, it doesn't matter. The risk is super high because there's so much that can go wrong in small businesses, which is why if you are going to give a young business money and basically put that money at risk, you might as well go big or you go home. Which is so if you VCs and let's say more experienced angel investors will only finance stuff that has the potential to go through the roof.
How do they calculate though? You were at Verve for 11 years. How were you deciding which startup deserves to get the money and how much money? Was it the way they talk about themselves? Was it how pretty their presentation was? Was it the potential for the market, the research that they did? What are the exact points that you're looking at that makes you decide?
Yeah. So to the point you made, how do you decide how much money you give? I think there it's just important. The dynamic of the relationship is not, dear investor, please give me money, and you say how much you want to give me. It's the startup that has a trajectory that they're on, and they need to understand how much money do they need to get to that next point in their journey. What you talk about is value inflection points. So I've developed my product and now I want to start selling, and I need X million in order to generate revenues of Y.
And let's partner up. Is that how it works?
Yeah. So, but then you go around and you try to find the investors that will finance that journey with you. Usually you find one investor with whom you negotiate the terms, and then you have a number of other investors that are interested, but they join as, let's say, as follower investors, and you have a lead investor. But to answer your other question, what is it you're looking for? So there's I'd say two elements. One is, do you believe that the market that the company is addressing is big enough? And is their solution something that is actually interesting for that market? So that's the first thing that you need to check, is do you agree that the market is that big? And that's quite difficult because oftentimes you're looking at things that don't exist yet. You're investing in companies that want to develop a market that's not there. Like otherwise you'd be talking about established businesses. So that's one side of things. You need to have as an investor a thesis and an opinion about a market and about the solutions that make sense for the market. That's one side. Mm-hmm. And then you look at the people, the team, and what matters most is how good are they? And how good are they isn't how good is their elevator. Nobody cares about the elevator pitch. A good investor is not, I don't care how many startup awards you won or stuff like that. It's more, okay, you're telling me what you want to do. If I challenge your assumptions, do you have good answers? Mm-hmm. So have you thought this through? Are you thorough? Are you serious? Are you methodical? Are you structured? That's what gives me a feeling that like you know what you're doing. But the thing that I want to see as an investor, or not me, but like any investor, is what the team, how resilient is the team? How adaptable are they? And how much are they gonna fight to make this
work? Do you challenge them in any way? Do you like throw something in the way to see how they'll adapt to it? How does it work?
No, usually it's this is something that happens over many months usually. So like you'll have a first call and they'll present their solution to you and they'll do their pitch and you listen, you'll ask a few questions, and then usually you'll decide, okay, do we want to go continue and go deeper, or do we say, no, this is not for us? And if you say, hey, we want to go deeper, and then you do a follow-up, and then you start challenging, and then you'll have like areas where you'd like to dig deeper into, and then you'll be like, oh, can you give me access to your data room? So usually a company will have prepared sort of like information about their market, how they're doing, their clients, their pipeline, all this, and you'll have a look at that, and based on that, you're going to have more questions, and you'll talk to external experts that you have access to figure out what you need to dig into or where you want to get feedback. And then you challenge them. But essentially, it's about, do I agree with the assumptions the company is making? And if not, I challenge those assumptions, and do the answers satisfy me, yes or no? But it's a dialogue.
And how is the relationship once you do get to invest? Because you mentioned something like it's 24/7.
No, yeah, but so the thing is, once you invest, it's a partnership, because essentially you're invested in the company and you want to see them succeed, and your role, you're not the one building the business, you're the one on the sideline. But again, we're talking about businesses that are not self-sustaining, so they're very dependent on financing to survive and to continue growing. And as somebody who gave them money, it's in your interest to make sure, hey, are they spending this smartly? And also you want to stay close because they might need money again in the future. And that's also where you come in. But oftentimes, as part of financing round, you'll have the biggest investor joining on the board as well. So you're actively involved as a board member. But again, I think it's important to bear in mind is you're investing in companies that you believe are really good. So you're not there to coach them, It's not like a mentoring
can you get involved? Is it generally acceptable?
Well, it depends how much. Is it like, hey, I have...
Like, say you have a startup that's doing something for logistics, and you come from logistics, from a well-established company, then you decided to become an investor. Can you say, hey, this is not going to work?
Yeah, but usually those are conversations that you had before investing.
Oh, I see.
And then it's and then they'll be like, oh, I disagree because of X, Y, Z. And then again, but a good entrepreneur is really stubborn, but also smart enough to know what they don't know. And that balance is quite important. But I'd say you can get involved. I mean, the most valuable thing you can do is you provide funding and, if possible, access to potential clients if you know people. But the most important thing is that you follow them closely and you make sure, hey, guys, if you're not spending this money smartly, you're going to get into trouble. I'd say that's the biggest sort of thing that you can help. And then help them sort of understand when they need to do their next fundraising round. And then you help them get access to that money.
So that means your 9 to 5 is basically looking at Excel sheets and having calls?
It's not Excel sheets because it's not corporate finance. Because but as a VC, what you're doing is you're identifying in companies to invest in, and you're having calls with those companies, and you're meeting those companies. That's usually one very large part, and the other part is you're working with the companies that you're already invested in. That's the second part, which is quite big.
How many can you fully dedicate yourself to without, starting to become too careless or burn out or something like that? How many can a venture capitalist carry by himself?
You're not working closely with. It's also, you make, let's say, as a partner at a VC fund, I don't know, per fund you do, 5 or 7, 8, 9 investments. But at some point, if you're good, you're only putting your effort in the companies that are going well. So a VC fund makes money on companies that generate a 10x for them. So it's the outliers that will drive the return of your portfolio.
And it's not that many companies, obviously.
No, and that's in any, also if you look, I'd say between a bad, a mediocre, a good, and an excellent fund, 80% of the portfolio looks the same. You have about half that goes bankrupt, and then you have roughly 30-ish% with a, let's say, 2, 3, 4x return. And then how many 10x's or more do you have in your portfolio? That makes the difference. And it's between 0 to 5. And those 4 or 5 companies out of 30 are the ones that
are the holy grail.
Yeah, and that's between my returns are really bad and my returns are exceptional. So your job as a fund is actually once you've made your investments to see which ones are going to be the high flyers and put all your energy into the high flyers. And that's on the one hand helping them, but it's also protecting your interests as an investor in those investments. So making sure that when there's a follow-on investment, you can maintain your stake in the company or double down and invest more. And there's all kinds of corporate shareholder actions where there might be something that needs to be signed, or there's documents where there's things that can happen, but you need to be on top of it to make sure that your interests are being protected. So I'd say a good VC spends the majority of their time on the outliers in their portfolio.
Someone told me last time, a startup co-founder, he said, try to steer clear of VC as much as possible because it might make your job harder as a startup, even though they give you the money that you need.
It's a sentiment I can understand. Again, a VC's job is to generate returns for their investors.
Yeah.
And they generate returns by investing in companies that have outlier potential. And outlier potential means that you're growing at an insane pace. Again, like you're not doubling each year, you're quadrupling each year, and you're doing that systematically over 3, 4, 5 years. That's how you generate a 10x within 4, 5, or 6 years. So a VC will invest in companies that have the potential to sort of grow on that trajectory. But again, a VC will also push you to go down that path. So a VC wants you to spend money and build a team and grow fast. They're never going to tell you slow down. And
obviously,
exactly,
it's like add 25th hour to your day.
Exactly.
We need you to work more.
And also hire and grow. And I want to see sales doubling, and I want to see results. And the thing is, it's a pace which is very difficult to maintain. And going from a 4 or 5 person organization to a 50 person organization in 2-3 years is very difficult. And most organizations don't survive that. And most people are not good at doing that. And you only figure out when you do it. So
what happens if you noticed, what would be the reason that when this jump happens, they usually fail? Is it the CEO is unprepared? Is it, we're not going to talk about the money thing. Like, what would be the reasons for why a promising startup just disappears really quick?
There's so many reasons. Because again, these are still companies that are figuring out how and what they want to do. And so just since looking at startups for so long, the one thing that I've learned is it sounds a bit weird. I've generated a deep respect for large corporations, because large corporations have many people working for them, which are paid really well. And these people sometimes, like, they're not pushing as hard, and still these companies manage to survive over decades
and the numbers keep going up.
Exactly, because they're robust organizations. And a startup is exactly the opposite of that. It's like this fragile little plant, and anything can just kill it. But I'd say the things that usually fail is the company actually doesn't achieve product market fit. So they don't manage to actually develop a solution which has enough pull on the market. That's one. I think one of the main reasons is that they figure out, we actually our client base is way smaller. It's much more expensive to win clients, and we actually earn less on them. And it's like, sorry, we thought it's going to be different. That's one main reason.
Thanks for the money, bye.
Yeah. But the other thing is also that they fail at scaling, because again, let's say you're a 4 or 5 person organization, you have $1 million in revenue. Made up numbers. And then you're like, okay, so I'm now going to hire 10 people to get from that 1 million to 10 million in revenue in the next 18 months, or to 7 million. And you hire those people, suddenly your cost base goes up, but you haven't yet generated the revenue. And then the people don't perform as that you want them to. And it takes you too long to realize that you need to adapt, because it's one thing to lead an organization with 4 or 5 people.
It's very fragile, agile.
Yes. And it's then once it's like 15, 20 people, it's still quite agile. But then when you go to 30, 40, it becomes a bit heavier. And you as a founder, as a leader of need to make the jump that you need to figure out how to do that. And people usually fail there, because also you have this thing where it's like, the beginning was so hard, and now we raise money, and now things are going to get easy. It's like, no, complexity
easier to spend, but that's it.
But the thing is, like, it's not that shouldn't give you sort of this feeling of like, okay, it's easier now. No, it's actually more difficult, because you've increased the complexity, and you've introduced new risks to your business, and sort of like the price of getting things wrong or just got a lot more expensive. And I think that transition from sort of like very early to growth is just one structurally that a lot of founders struggle with.
So what exactly happens when a startup fails? for you on the venture side? Like you invested in them money and then they say, hey, it didn't work.
It's never that clear cut.
No?
Usually it's...
Do you pull out before when you start noticing signals? No?
You can't pull out. Well, you have equity in the company. You're a shareholder. It's not a loan that you can be like, hey, here, I'm taking my...
That's what I mean. Like, do you try to sell out or how like...
So it depends. There's different scenarios. But basically, I think, first of all, recognizing, okay, this is not working is a process that takes time because they try, they push, and so basically, like once you realize, okay, and it's not like they're going backward. It's just they're not growing as fast as they should, which means raising new capital is going to be really hard. And at some point, the justification for existing investors to provide additional capital just isn't there anymore. So I'd say there's a number of things that you can do, or not just you as an investor, but as a company, where it's like, okay, we've had one hard year, we only grew by 30-40%, or growth stagnated. Okay, our existing investors are going to give us one more cash injection that provide us another 6 months, and in those 6 months we need to prove that we can grow, and otherwise we need to do something else. So that's one thing, is like you consciously make a decision, we're going to try again to really get back on that growth path. The other thing is to say, okay, we make a conscious decision, this is no longer a company with outlier potential. The mindset needs to switch from growth to profitability. We're going to try to turn this into a profitable company.
With what it has.
Exactly. So it's like, okay, we're going to reduce headcount, we're going to focus on the clients we have, we're going to get our costs under control, and we're going to grow at a different pace. But then it's basically you're giving up your fast growth startup dream and you're saying we're turning this into an SME. Another option is then to say we try to sell the business. So we'd be like, hey, we have something which is valuable for certain types of players, and we believe that if we can achieve price X if we sell to this company, so we're going to try to sell it.
Which is also a good thing.
Of course, yeah. But that's ultimately what you want to do as an investor. Is you want, again, IPOs. Nobody IPOs. Hardly anyone IPOs. You don't invest in a company assuming they're going to IPO if you know this industry, but you assume they're going to be sold at some point. That's how you make your return on investment. So you can say like, hey, you know what? We don't think we're ever going to sell this so that we make a 10x, but I think right now we might be able to sell it and get a 1.5 to 3x, get our money back, and we've found sort of a home for this. That's a good option as well. If things are more difficult, then you might actually, so these are the scenarios where it's like we're still in okay territory. It's not yet, shit hasn't hit the fan yet. But if shit hits the fan, then you might want to do a restructuring. So basically, you recapitalize the company. So you do another financing round, but at very attractive terms for the new investors, and you basically wash out everybody that's in. So basically, you write off your investment unless you're joining again, and that gives the company a chance to reset. But then usually with more of a SME type of mindset than a fast growth. And the last option is you just close the business. But again, this is not I would always look at it from a perspective of the company, not an individual investor. So it's the company and the board that decides what do we want to do.
You can't suggest or impose decisions.
Depends on the controlling organ of a company is the board. It's not one investor or two investors. It's the board and executive management that control the company. And that's the form within which these decisions are taken.
Listening to you makes me really respect Zuckerberg for what he did. Because it sounds so hard. And then this one guy with just an idea for a social media network is still there today doing this and growing it with so many products that failed along the way. The metaverse and the AI stuff. And we saw the glasses not work. So I'm guessing he's the outlier of the outliers with how he made things work.
There's a few such examples, but again, that's what
because we as a Facebook user, I always criticize like this guy did something useless again for us.
But he's, again, like if you look at it from a VC perspective, that was an exceptional investment for the people that were in, and I think that is what this industry is for. VC is not here to finance.
Battle you.
Yeah, no, but they're also, their focus is in finding those exceptional outliers and investing in those exceptional outliers because they're the ones that drive returns in this industry. So it's like it's like, I don't know, 5% of venture-backed companies generate about 60% of the return. And those are the 5% that generate 10x or higher returns for their investors. But the more you go to the okay, what's the proportion doing 20x, 50x, 100x return? Like what actually happens is that it's the companies that are the most on the edge in terms of like the most outliery cases, like they cover a large part of the returns. Like this industry is about finding those exceptional companies and financing them and then making a return on it.
Let's give some advice to the people that are watching and listening who are just beginning a startup or thinking about it or are already kind of, moving things. What or how can the founders build and manage a funnel effectively for when they start talking and receiving some funds from VC? How does that work exactly?
So specifically about fundraising,
Yes.
correct?
Yes. We'll start with that.
So, I mean, it's understand which investors make sense for you. It doesn't make sense to just reach out to any type of investor.
Because it seems like, everybody wants to give me money, or I found someone who finally wants to give me money.
Yeah. I mean, you want to take money from people that make sense for you and not just take anyone's money and also not reach out to just anyone. So obviously identify investors that invest in your industry, in your geography, in your sector, in your stage. And then the best way to do it is to reach out to them prior to actually needing their money, because that also, there's a different dynamic. If I come to you and I'm desperate, or I come to you and I'm like, hey, I might be interested in working with you in a year's time, but like, let's just get to know each other now. Mm-hmm. So I'd say that, identify the right people, reach out to them early on, and try to build a genuine relationship with the ones that you really want to work with. So that means, and this is honestly, this is what I tell people, not just about fundraising, but generally sales, is who's sitting in front of you and what matters to them, and let them feel that they're being seen and heard, and genuinely see them and hear them. Because otherwise, if you're just coming and be like, hi, Alex, so my company does this and I'd really like, because are you interested in giving me money? It's like, you're like, well, no, exactly. But if I figure out what you're interested in, and I look at the investments you made and I tell you, oh, congratulations on that one. Or like, hey, by the way, here's a company that you should maybe have a look at because I know that you're interested in this space.
Sales talent is so important.
Yeah, but it's
everything we do, not just like startups. Every job, basically, you have to sell.
Yes.
And I tried being a professional salesman once.
Okay.
I think I failed spectacularly at that because, see, I'm good at building relationships with people, but I'm not good at building relationships with people to profit from it.
Okay.
Because that's the point of sales, right? You're doing something with a goal in mind.
But again, I think if you're in business, everything's transactional in business, and just accepting that that's the nature of the relationship, I think is okay. The way I always looked at it is that I'm only going to try to sell you something if I think it makes sense for you. And if it doesn't make sense for you, then I'm going to say that it doesn't make sense for you. Doesn't mean that I don't want to have this relationship with you. And
because you might know someone who has...
Who knows? Yeah. But there's the value of telling somebody, you know what, I don't think that this makes sense for you, is huge. And yeah, but again, if you're building a business, like, you need to have that mentality, and you need to, and I think the difficult thing about sales is that you do 100 reach outs and you get 5 people being like, let's have a conversation. Of those 5, 3 end up being like, hey, let's take a closer look. And then 2 end up signing. And you basically had to hear no 98 times and you heard yes twice. And that's considered really good. That's considered success. Whereas your emotional response to hearing no 98 times is it's a drag.
Yeah.
So, and I think that's what makes sales so hard.
It's starting to become really hard to pick up the phone.
Yeah, that's the thing that makes sales so hard, is that accepting the rejection again and again and again and again and again, and just accepting that that's part of the game is like, that's.
Speaking of success, out of the hundreds of startups that you work with, name 2 that you were really proud of what they achieved, or what your return on that was.
I mean, at my time at Verve, where that's my investor experience, because I don't invest now or I didn't invest before, so it's within the context of Verve. There was a number of companies that we invested in that exited nicely and that generated a nice return for investors between, I don't know, 5 to 10x or more on
So
the
you did
investment.
find some of the outliers.
Yeah, for sure. I mean, again, we had the portfolio. I think in total, in my time at Verve, we invested in over 160 companies, and I think I left about a year ago, so my numbers are a bit hazy. But it's been about, I think there was about 30 exits in my time at the company, and again, some of those were quite nice. Others were more sort of in the 2, 3, 4, 5x range, but there were a few of those outliers with a 10x or more.
So, but having this success at Verve, and for this many years, you exited yourself, and now you're basically sharing the knowledge with everybody else. What made you decide this? Because it seemed that, as an investor or someone that manages investments, your life should be very comfortable.
Well, just to be clear, my role was not to pick the companies. My role was I was head of investor relations. Mm-hmm. So I was managing the relationships with the investors. The reason I decided to leave is I've been doing it for 11 years. And I noticed that I'm sort of plateauing in terms of like...
That was going to be my next question.
Yeah, I don't feel like the challenge was becoming less sort of like, it was still hard. It was still hard work. So don't get me wrong. It's like, it's not that I started coasting. It's just the challenge of doing something new and was kind of a bit gone. And I think that's an advantage of being a shareholder in a company versus being just an employee, is you think from the perspective of somebody who owns the business, and I think you more naturally take decisions in the interest of the business and not just for your own personal interest. And I noticed that, I was no longer doing my job with the same drive that I was doing it before.
Not emotionally invested anymore.
Yeah. And then, so me, the shareholder, decided that me, the manager, was no longer good enough. So that's why I decided I have to go.
But you, the shareholder, stayed?
Yes.
Oh, that's nice. Okay. So the plateauing. I kind of skipped, but I want to go back to startups. There's definitely, and I might be wrong here, a point where a good outlier startup starts getting stuck in what they're doing. Like, they're growing, everything's fine. And then, shit, I don't know, it's not growing anymore. What's going on? How do we figure this out? In such a situation, if you've ever had any, how does it usually get unstuck out of it? Pumping money, I don't know if that will help. Is it?
But it's also, let's say, the natural progression of a business that your growth will start to stagnate at some point. Like that your forward-looking potential remains sort of in this crazy exponential space. That's something that at some point also flattens out a bit and becomes a little bit more linear, which is also like, once you develop a certain size of business, that's also reasonable. Yes. It's okay. So it's basically, I'd say, there's scenarios where this happens, and then you need to transition from, hey, how do we continue to grow, to be like, okay, let's make sure, we need a different profile. We become a different type of company. We need to now work on our unit economics. We need to now hire people that will manage this and not drive it into the next step. We need to bring in more, let's say,
so corporate more adult.
Yeah, exactly. You need more adults in
education.
The room. I'd say that's one thing. Another thing is then, okay, we've reached what we want to reach. How do we exit this? Maybe it's time to sell this to somebody. Or it can be, it's time for a change of management, because maybe the person that was driving this is no longer the right person to bring it to the next level. I'd say those are sort of the
Also, regarding this, the person that I had last time, we were talking about, why would he leave as a manager, or if he's ever, as an investor, suggested that someone change the management of the company, like for the good of the company. When you see the CEO starting to get either not prepared enough or burnt out, or just not enough of him or her. Has that happened to you, and how does that dynamic usually work?
I'd say,
like, hey, Mike, You're tired.
Usually,
Get
again,
a second guy.
usually this is not something. Again, I think it shouldn't be the investor comes and kicks you out narrative. To me, it's more. It's something the board sees.
But you're on the board as an investor now?
Not always.
Okay.
It depends. And usually you'll have per round, you'll have one investor joining the board, if at all. But usually this is also something that comes up within executive management. So it's not like the board says you need to leave. It's like the board and executive management kind of feel, you know what, this is not really working. But there's a million different scenarios. There's scenarios where, the board feels like, okay, this person's not right, we need to kick them out, and the person fights it. Or there's a situation where the rest of the co-founders and the management team feel like, okay, this person no longer makes sense and like one of us should take over. There's situations where the person themselves will realize, look, I can't do this anymore, or I'm not right for the role, or I don't think I'm the right person for this. So there's different ways this plays out. But in my experience, and again, I don't know how representative this is, but this is usually a dialogue that's happening within board and management together. But we bring in somebody, the thing is, bringing in somebody external to just take over is usually really, really hard, because
it's like a new government. They need time.
Not just that, but it's like the skill set necessary to run a company between early stage and scale up and growth phase. It's a very specific type of person that's good at that. And usually sort of like more, let's say, corporate type of executive leadership role, these people are not good at that. And there's just like a big risk that so this person's leaving. So you already have the whole difficulty about like, okay, what about their ownership? Because then you have somebody who's no longer in the business, but still owns like 20%. So do you have sort of like reverse vest, like, retroactive vesting on founders so that they have to give back a portion of their shares so that you have a package you can give to somebody?
You can do that?
Yeah, you do that very often. Is there a package that you can give this new person, because you can't pay them an exorbitant salary, so you need to have them, you need to create sort of this long-term alignment. But there's a huge risk of bringing somebody external on board, and if they're not good, then
So there's no professional, let me save your company kind of guys.
Sorry?
There's no professional, like people that just go into startups and fix them.
There's people that say they can do that, but frankly, I haven't seen it too often. Like it exists, but it's also...
So it's a thing.
Yeah, but it's not
It's like on his LinkedIn, I saved startups.
Yeah. People like to say that, but I think a lot of them are not as good as they pretend.
To the end, maybe it's not related to you or your experience. We all seen Elon Musk try to get $1 trillion from Tesla in the next few years if he achieves some goals. Is that a good mindset for a startup founder, where he goes to his investors and be like, hey, this is what I'm going to do, and if I do that, this is how much I want? Is that a good approach to how you talk to your investors and how you see your company as well?
I don't think this case is applicable to anything else, because first of all, it's a publicly traded company. And I don't know how many people out there are running numerous, highly successful, massive global businesses at the same time. So he's also a bit of a special case, I'd say.
No, I just took like his example of
but I don't know if that example. But the action... Usually if we're taking it way back to the early sort of growth stage context, you as a founder, if your financing rounds went well, you still own like a substantial portion of the business by the time you get to even when it's a bit later on. So your incentive is mainly, hey, when we sell the business and we sell it for a lot of money, I own 10, 15% of this business. That's my incentive. So your ownership stake is the thing that determines sort of your long-term payout, essentially. So big share packages on top that are like exorbitant seldomly make sense. You can have an option.
You're right, because thinking about it, if you are going to investors to ask for money, but you have money,
you have
then why don't you buy more?
But it's more sort of like in the startup context, if you have an option pool, you use that to attract new talent. But it can also be, hey, we had great results, so there's a great bonus also for management. Yes, but I'd say your biggest payout comes from the fact that you, from the beginning, own a large part of the company.
And the company is still going.
Hopefully, yeah.
All right. For the complete end of this podcast, and it's been a great conversation. I hope people that are watching will have the same. What do you think is the next big thing from your interaction with startups in Eastern Europe that they might come up with or jump into? Did you notice a trend? Maybe because we tend to feel as Eastern Europeans that we always are more creative and we have something that nobody else in the civilized West knows. Did you notice anything? Hey, this is weird. I think it might work.
I mean, I talked to specific companies working on specific things, which I think are pretty cool, but like, there's no trend that I recognize being like, oh, I think this is going to be big in the region. Also, I try to avoid making statements about the future in
You're not a prophet.
I'm not. Unfortunately, I'm not a prophet, and I've learned the hard way that it's seldomly the things you think that are going to be big that are big, or at least in my case. So I'm very bad at predicting. Yeah. So like a lot of some of the companies that we invested in at Verve that were the most successful at the time of investment, I'm like, really this? So that's why I've learned to be quite humble when it comes to my personal opinion on
Okay, so what's the idea that you heard in Eastern Europe that you went like, really, this? Because
I also don't want to say, because maybe the people that I talk to will be listening to this and be like, really, you think I'm ridiculous?
No, not the specific startup or exactly the field, but like what activity, I guess, I don't know, more generally, why? Like logistics or, something like that.
But there, yeah, I don't.
No, I'm not going to extract it from you. No. All right. Thank you so much for coming to the podcast.
Thank you so much as well.
You are the last episode for this season.
Really?
And right before Christmas. So
Merry Christmas.
Yeah, thank you. We have two.
You have, Orthodox Christmas and...
we have the old calendar Christmas and regular people Christmas.
Okay, nice.
Very happy you came here. I hope you got, or the startups that you met, got the information that they required for their activity. And I wish you to become a prophet maybe soon.
I thought you're going to wish me a Merry Christmas.
Merry Christmas too. Thank you. Dragi prieteni, mulțumim dumneavoastră pentru că ați fost alături de noi pe parcursul acestui sezon. Noi am filmat 10 sau 11 episoade. Toate au fost fascinante, cel puțin pentru mine și cei care au văzut și mi-au povestit despre podcast. Sperăm să revenim și la anul. Iar pentru acest episod vreau în special să mulțumesc Moldova-Swiss Partnership Project, proiect pe proprietatea intelectuală finanțat de Confederația Elvețiană, că ne-au ajutat să-l aducem pe David aici și, desigur, și startup-urile care au interacționat cu el. Ne vedem la anul. La mulți ani și Merry Christmas!